COVID-19 pandemic. And whether it's on Facebook Live, whether it's on YouTube, Instagram, I've seen a lot of misinformation. And also I think it's things that will, truly hurt you if you're starting to or thinking about investing for the first time. So I think today's presentation is very valuable in the sense that we're trying to give you the right tools that you're going to need to build that foundation, to also give you the confidence to go out there and start investing and make proper decisions. With that said, I will jump into my presentation right now. Alright, so next we want to talk about the 3 pillars of investing. And those 3 pillars are diversification, asset allocation, and also reviewing your portfolio. So these 3 things are very, very important. One, with diversification, you always want to make sure you're not putting all your eggs into one basket. We've all heard that term before, don't put all your eggs into one basket. Second is asset allocation. Asset allocation, truly determines, how is your money spread across many different asset classes. And when we talk about asset classes, we refer to things such as large cap, small cap, and also mid cap. So an example of a large cap company would be like a Coca-Cola, a Pepsi, Home Depot, Nike, Apple. An example of a small cap company would be something sort of like a Wendy's, or a lot of small pharmaceutical companies as well, would probably fit into that mix as well. So they're not quite, in general they are big businesses, but they're just not quite as big or on the scale of, let's say, a Nike or a Pepsi as well. And then the last thing is a periodic review. When it comes to investing, it's not something you want to just set it and forget it. It's a strategy. Whatever strategy that you do use, you want to make sure that you're periodically reviewing your investments, making sure they're still right for you, and making sure they do still fit within to your long-term, your short-term, or your intermediate-term goals as well. So the first pillar that we're going to tackle and go a little bit more in depth with is going to be asset allocation. So there's many different types of asset classes, as I mentioned before, that you can invest in, okay? So those main asset classes are typically cash, equities. So when you hear the word equity, think of that as stocks or the stock market. Fixed income, when you hear the word fixed income, think of that as bonds or the bond market. So a good example of a fixed income would be similar to what we call as an IOU. So hypothetically speaking, if you were to borrow some money from me for an extended period of time, I would probably want to charge you an interest rate. And until I get that money back, you'll be paying me periodic interest. And then at the time when that time frame is up, when you have to give me the money back, then you pay me back in full in my full principal. So when you think of fixed income, when you think of bonds, think of them as an IOU. And lastly, the last asset classes, which are probably a little bit too advanced for today's lesson, but will be alternatives. So we've all heard of hedge funds, private equities, certain real estate assets as well, certain limited partnerships. So those alternatives will probably not be something that you would probably get started with right away. But over time, as you develop your base, as you develop some more tools to invest in, there'll probably be some asset classes that you want to branch into at a later date. So why is asset allocation important? Okay, it basically helps you balance your goals and your time horizon with your risk tolerance. Okay, so what are those? So I would say the first thing when you do any type of investing, what you have to ask yourself, what is the why? Why am I doing this investment? Is it to make a little bit of money short term? Is it to long term, grow my money so I can retire comfortably? Or is it to put away some money for a period of time, maybe not short term, but maybe 5 to 7 years where I can save for a house? So the why is going to be very, very important, because the why then also dictates what type of investments that you may want to hold. So if it's something very short term, as we know, the stock market is very volatile. So if it's money that you want to put away for a short-term goal, chances are you don't want it into a volatile stock market, because today you may put in, let's say, $1,000 into the market, and tomorrow it may be worth, let's say, $800. So oftentimes that discourages people from investing into the market because they invested short-term money in longer-term investments. So with that said, make sure that you have a distinct why, you set a goal, and you also put a time frame on that goal as well. So what some of the things that you want to keep in mind when you're diversifying your investments into each of the different asset classes, you want to look at geography. Okay, we have a stock market, which we refer to oftentimes as the S&P 500, which is the 500 largest companies in the U.S. stock market. But there's stocks in other markets as well that you can invest in. That's domiciled in the UK, Germany, China, Japan, and other countries around the world too. So you certainly do have access to these areas and investing in companies in other areas as well. But it's going to be much harder to do your due diligence because the information on these companies that are abroad is not going to be as readily available as maybe, say, a company like an Apple or a Google that is domiciled in the United States. Then you want to look at sector. There are many different sectors that you can invest in. You can invest in technology. Technology is a sector that's really been driving a lot of the market returns over the last 10 years. And we certainly think going forward that they will continue to do so. Because what's happened during COVID-19, the tech companies have been the leaders, because now that the workforce has shifted from working in offices now to home, technology companies tend to be the leaders for innovation, in the work from home lifestyle as well. Then there's other sectors such as automobiles. You have airlines, you have consumer discretionary. So these are things such as, your Walmarts of the world, such as, your Procter & Gamble of the world, and then you have your financials as well. So those would be the big banks, the big lending institutions as well. So there's various different sectors that you can put your money into as well, both from a stock and a bond perspective also. Then you want to think about liquidity, okay? Never invest money that you need to be liquid. So hypothetically speaking, if you're saving and you have your short-term emergency savings account, that is not money that you want to now invest into the stock market. Because if anything goes wrong, then now you're putting not only yourself but your family also at risk of not being able to meet a requirement, when a situation may present itself, when an emergency may present itself. Okay. Next, you want to look at the quality of the company. Okay, and in the bonds perspective, you want to look at maturity of the company as well. So quality meaning, we all know a lot of the bigger name companies as well. So just like individuals, we have our credit scores. A lot of companies have credit scores as well too, and they're judged. So you'll have investment grade type companies, and these are companies that carry a very strong rating. Okay, they're very sound, they have great liquidity, great cash positions on hand. So meaning they're very nimble in, tough market environments as well. So those are companies that you more likely will want to invest in because, they can weather storms a little bit better than companies that, let's say, don't have as good of a credit profile. And we all know, if you go to an institution and you want credit extended to you, if you have a good credit score, chances are your borrowing costs are going to be a lot lower. And if you have a poor credit score, then you're probably paying more as well. So that works just the same for corporations as well. Corporations with good credit quality, they tend to pay less borrowing costs as well. Okay? The next thing is size. As we touched on before, we have mid cap, we have small cap, we have micro cap stocks as well too. So you just want to make sure that, the company that you're invested in, it's not necessarily wrong to just invest in small cap companies or just invest in large cap companies. But if you want something that's probably going to give you a little bit more stable growth and less volatility, the bigger the company, the chances are you'll minimize your volatility a lot more as well. And then style. There's something called style when you see investment style. So the primary ones that we know are value-based companies and growth companies. Okay, a growth company tends to fit the mold of a lot of the technology companies. So these companies are really focused on growing their stock price for the long term. Okay, Whereas a value company, you'll see growth long-term in a value company, but just not like you would in, let's say, a growth company. So a good example would be, let's say about 7-8 years ago, Amazon was trading at around $200, $300, $400 a share. And now a company like Amazon, which is a growth company, is trading at over $2,000 a share, okay? So their growth comes in the stock price appreciation, okay? And then let's now take a company like a Coca-Cola, hypothetically, or a Walmart, or a Johnson & Johnson, okay? Those companies will not see the same type of growth, but what they do give you on a quarterly basis are dividends. So these companies, somewhere in the range of 3 to 5%, you get a little bit of dividends every quarter, and then you will also get some long-term growth from these companies, just not at the level of what you'll see some of these bigger tech companies will give you as well. So oftentimes when we talk to people about investing, you want to balance up both companies, because the dividend-paying companies tend to have stronger balance sheets as well. And the nice thing is, when we are in a market environment like we're in, where the market overall has been down, those dividends still continue to come in for you, okay? So you're still able to receive some additional income or continue to grow your portfolio from dividends as well too. And then once everything recovers, all companies should benefit from that. Next slide I want to talk to you about is on diversification. Now, as you can see on this slide, we just see a bunch of colored boxes, going from the left side all the way to the right side. So from left to right, we have 2008, year 2008, all the way over to 2019. Each box represents a different asset class, like we just talked about briefly. And the dotted line also represents a diversified portfolio. And what that means is you just have a mix of each asset class within that portfolio. So you don't have all your eggs in one basket, okay? So some years, we just don't know what particular asset class will do well. Will large caps do well? Will international stocks do well? Okay? Will small caps do well? Or is this an environment where fixed income or bonds tend to do well? Okay, because of such a volatility. But if you notice in the middle, that diversified portfolio, it kind of goes right along, and for the most part, it stays right in the middle. So what that is represented to you is that the diversified portfolio tends to be less volatile. So the stock market could be a seesaw, a roller coaster, big ups, big downs as well. But investing in a diversified portfolio tends to kind of help smooth out those ups and downs and make that ride a little bit more manageable, or I should say in this scenario, a little bit more easier to stomach as well, okay? And long-term, a diversified portfolio, I think, should benefit most long-term investors, okay? We'll go to the next slide. So, other things that you want to keep in mind, when you're looking at diversification as well. As we talked about, is volatility. Volatility is really, just a measure of risk that's, you're taking on within the market. So the higher the risk in your portfolio, the more volatility you're going to also see in your portfolio as well. Meaning the up and down, the swings up making money, or the swings down losing money as well. So oftentimes people just cannot stomach, that level of volatility. So they would rather see things kind of a little bit more smoother. From point A to point B. Let's say if you're investing for a longer term goal, you should have more money, at point B than where you started at point A. And what kind of dictates, how that ride goes is really the amount of volatility that you have in your portfolio and the level of risk that you're taking. So keep this in mind. The more risk that you're taking, the higher the amount of volatility, meaning the spikes up and the spikes down that you will see in your portfolio. And also, as I mentioned before, liquidity. Make sure that you have adequate liquidity, because if you're putting all your money into the market, and you go through a period where we have extreme volatility in the market, and you see some heavy losses in your portfolio, then now you've just lost a chunk of funds that you needed, for for emergency purposes as well. So that's why we always want to make sure your liquidity base is set and safe, and then anything above and beyond that is what you probably would look to invest and put into the market as well. Because if it does go volatile, then you're not necessarily worried about, taking care of those emergencies at home. All right. Next one I want to talk about is inflation. A lot of people, are familiar with what inflation is. Simple definition of inflation, it's basically the increase in cost, the rise in cost of goods and services. So for instance, 5 years ago, a loaf of bread in the supermarket may have cost you $1.50. Today, that same loaf of bread may cost you $2.50, okay? Why is inflation important? If you're not doing anything to curb inflation, then essentially your spending power decreases over time. So your dollar today is not going to be worth the same as a dollar that you have in the future. So meaning, if you had $1.50 today to buy that same loaf of bread, you're not going to have enough money to buy that same loaf of bread today. Okay, or in the future, excuse me. All right. Interest rate is another thing I want to chat with you guys about too. Right now, we're in a very low interest rate environment, okay? So with the markets, being very volatile as they are with the pandemic, the federal government has decided to basically keep interest rate at virtually zero. So that just means that if you're going out there to look for opportunities to invest safely where you don't want to take on the risk in the market, right now the banks and the credit unions aren't really going to give you much interest for for the money that you're going to have on deposits as well. So a lot of people oftentimes look for alternatives. Okay, well, what can I do, that's going to yield me some additional funds right now, where, maybe I'm not taking on too much risk. But right now with interest rates being as low as they are, it's going to be very, very tough to kind of find a safe vehicle to put your funds into. But on the flip side, if you're a borrower, let's say, you may want to refinance a mortgage. Let's say you're looking to buy a car. Let's say you're looking for a new mortgage to buy a new home. Right now, those interest rates are low too, and historically low. So if you're in a borrowing position or looking to borrow funds, you will be borrowing at lower interest rates as well too, okay? So we'll go to the next slide as well. So I want to talk about, now that we've invested some funds, you've diversified your portfolio, you've spread your risk out a little bit, you have some different asset classes as well. What are some of the factors that you want to look at to now start to review this portfolio, just to make sure it's still in line with what your goals are, short, intermediate, and long term, and also it's still the right portfolio for you? And is that why still the same? Remember when I, said earlier, when you're looking to invest, you want to have a why behind it. And if that why has changed, then certainly that should also trigger you to start reviewing this portfolio as well, okay? Couple things also may trigger that as well. Market forces. Obviously with this pandemic, people who are invested or who were invested for a long time, now may be the time that you reach out to your financial professional and ask questions about what's going on, how does that impact my portfolio, and more importantly, how does it impact my why? So if your why hypothetically may be, I want to retire in the next 5 years, I just lost 20-30% of my portfolio, how does that impact the amount of money I'm able to rely upon during retirement? Okay? Also, a change in your personal situation, another why. Maybe your family structure is a little bit different, okay? Maybe, you don't need as much money you thought you needed before to retire. So all those things will factor into, reasons behind why you should have someone take a look at your portfolio or reach out to your financial professional to make sure that you're still on track for whatever those goals are as well, okay? And also future economic outlook. Right now, we have about 30 million people unemployed in the United States, okay? So right now the government is doing all that it can to kind of help prevent, basically the economy from falling, completely just, going into crumbles. So a lot of this that we see right now is going to be, let's say, inflated. Any kind of stimulus that the government is offering us, it's going to kind of inflate the economy in a way where, we really don't see the worst of it yet. But in about 6 months or 9 months, or let's say even a year from now, when those numbers, those unemployment numbers, we kind of adjust them as well, we would then truly see, what we're currently dealing with also. And you have to understand that a lot of people probably won't be going back to work, or now that we're moving into this work from home, a lot of corporations as well won't need as many people in offices anymore. And our services, our restaurants, our bars, they probably will start to operate with, much less staff due to certain restrictions in each state. We talked a little about why is it important to review your investment strategy. As I always tell people, Rome wasn't built in a day, okay? So if this is your first entree into investing, I strongly encourage you to build a knowledge base. Do some research. There's a ton of tools out there. There's a ton of resources out there for you to start reading up on and just giving yourself somewhat of a foundation in investing. As we talk about it in the Bible said, a home built on sand doesn't last, but a home built on a solid foundation, will last you. So that's how you want to kind of look at your investing as well. Build a solid foundation and a knowledge base up on investing so that you can better understand when engaging and when talking with a financial professional that everything doesn't go over your head. Because I think your best teacher will end up being yourself. You will always be your best teacher. Okay, but you have to really take the time and invest the time into really learning some of these concepts, and then as you look for more expert advice, then you can engage a professional. So again, take a goals-based approach. Look at those life priorities. Understand your life, where you're at right now, where you want to be in 5, 10, 15, 20 years down the line. What do I want from my children? Do you want to put away something for education for the kids? How old are the kids? When will they get to college? Okay, now you can start, prioritizing these goals and these needs and creating a financial strategy. And that strategy is going to involve your risk tolerance, the time horizon behind it, and how much resources do you have to put behind those goals as well. And from there, we can construct a portfolio that makes sense, for all those reasons. And then the last step is really to review. Review that process, revise that process, make sure those goals, those priorities are still the same from when you started with them. Ultimately, we can all be, I would say paralyzed with the amount of information that we get on a daily basis. But I think the important thing really is to start. And that doesn't necessarily mean go today, download an app on your phone and start investing. But start the process. Start doing your research. Start reaching out to financial professionals. Start doing some investigation and seeing what things may make sense for you and your family and get the process going. Because right now, unfortunately, especially with people of color, we are way behind the 8 ball with this, okay? We have the opportunity to create wealth, not just for ourselves, but for generations to come, by really just implementing some simple tools. But I think most importantly is the discipline that we put behind there. Just like you're disciplined to doing certain things, whether it's getting a haircut, whether it's doing your nails, whether it's going grocery shopping, whatever it may be, you are disciplined to do certain things. Put that same type of discipline behind your investment process as well. And that's how we truly start to build. We start to grow wealth in our communities, and that's where everything trickles down. It trickles down and we truly create generational wealth for our kids and our grandkids as well. So now I want to talk to you guys about, the different structures or the different types of accounts that you can actually do some investing in. Some of the more popular accounts that you've probably heard of are your deferred compensation account, which is if you're a state employee that you have through work. Your 401k account, if you're working for a private sector employee that typically have a 401k. And then also, if let's say you're a teacher, you may have what's called a tax-deferred annuity or a tax-sheltered annuity as well, where you can add supplemental funds into outside of your pensions that you will receive also to also invest. Typically, these accounts only allow for certain types of investments, and those typically would be mutual funds. So what a mutual fund is, it's going to be a basket of different investments, whether it's stocks, whether it's bonds, or a combination of the two. So the purpose of the mutual fund really is to give you exposure to the market, but also do it in a diversified way and also spread your risk across, several different companies, as opposed to just focusing on one company that you would within, such as buying an individual stock, okay? The next type of accounts that you can invest in would be a brokerage account, which is probably the most common account that most people look to invest in. So within a brokerage account, which you can set up at various different financial institutions, and also keep in mind, you can Google this, you can, figure out a way, just how to search, how to invest into a brokerage account, and many, many different ads I'm sure will pop up for all the different services that are out there to kind of help you get going to open up a brokerage account. But primarily a brokerage account is what most people will open if they want to do some investments on the side, whether you're buying stocks, bonds, mutual funds, and then also another type of investments that's very popular today, which are ETFs, exchange traded funds. So these funds tend to track a market sector. So you can track the overall market with the ETF, you can track just the technology sector, you can track healthcare, financials, whatever it may be, but the ETFs can give you exposure on a broad-based level, or also exposure that's very definite or finite to a particular sector that you're looking to invest in, that you may have confidence in, that you think could benefit you long-term as well. The other types of accounts that you can invest in are your IRA accounts. So that's an individual retirement account that you can set up on your own, and based on your age, there are different limits of the amount of money that you can put into those accounts on a yearly basis. And then you also have a Roth IRA account as well, which offers you different tax benefits also when you do access these funds in retirement. So those are the accounts and the type of accounts that I just wanted to briefly go over where you can start or begin investing. So oftentimes, some of you may already have a 401k. Maybe it's a 401k that you no longer manage, or you no longer work for the corporation. So you really should probably pay attention to what you have in there and what it's invested in, because that's going to be very, very important. Because as I mentioned, with these investments, especially if they're geared towards longer term as well, isn't something that you want to just set and forget. You want to pay attention to what you have inside of these accounts and what do they mean to you, how much risk are you taking on, and really truly understand what it is that you own, okay? So I want to thank you today. I want to just to say I appreciate your time. I appreciate you, tuning in today. If anyone has any questions, please email our financial secretary with any questions for me. If you want to call, she will provide you with my contact information as well. We can have a one-on-one conversation, if that's what it is that you need. Do keep in mind, oftentimes people think, what is this going to cost? All the consultations are free. We can guide you in the right direction and kind of get you started. But like I said, the most important thing is for you to take the initiative and start building the foundation for yourself and building your knowledge base as well. So thank you, Metro. I love you, and looking forward to doing this again.